Welcome to this Monetary Policy Special. The Monetary Policy Committee of the Reserve Bank voted unanimously for a rate cut on April 9th and an accommodative stance, and the minutes of the policy, which are just out, indicate a strong dovish tone in the writings of practically all the members. Governor Sanjay Malhotra has summed up the arguments beautifully in his minutes by saying that with CPI inflation aligned to the MPC's target of 4% and growth moderating, it was logical for the MPC to cut rates and change the stance to accommodative. Strongly agreeing with him were the other members, including Mr. Nagesh Kumar, who has actually very strongly pointed to the hurdles to growth emanating from the global sphere thanks to the US tariffs. Joining me now to comment on the minutes and the state of the global economy and the Indian economy is Mr. Nagesh Kumar himself, external member of the MPC. In a bit, I will also be joined by Abhishek Upadhyay of ICICI Securities PD and Suvodeep Rakshit of Kotak Institutional Equities to give us the market impact and market reading of the minutes of the MPC. But first, let me welcome Mr. Nagesh Kumar to the conversation. Thank you very much, Mr. Kumar, for joining me. First, if you can parse the global environment, sir, the way you have written it looks like a recessionary conditions are imminent. Can you tell us how bad this impact can be on Indian growth? Should we be prepared for something less than 6.5?
I mentioned in my statement that there are two or three things one should worry about, because the meeting happened during 7th to 9th,
yes,
and that was just exactly 1 week after the 2nd April Liberation Day announcement of President Trump, where he slapped very high tariffs on every country. Now, some of our Indian economists and analysts are reading something positive in it because India was, sort of slapped with 26% tariffs vis-a-vis other countries, our peers, a much higher, percentage. So we were taking a bit of relief that we may be spared lightly, and we may actually be able to make more inroads in the United States market because our peers are facing higher tariffs. Now, but that is only part of the story. The second part of the story is that China, which is facing 145% or 245% kind of tariffs, and that means they will be really eased out of United States market, and the kind of excess capacity they are sitting with and the deep pockets, they will begin to dump that capacity in Indian market and in our other destinations of exports, EU, UK, and rest of the world. So we may be getting a hit in our exports and in our domestic market, domestic production as well. And the third thing I pointed out was that there is a serious risk of a world economy getting into a kind of a prolonged recession, which may impact Indian economy also like any other. So there is a compounded kind of thing, but that is all evolving situation. One has to see how the negotiations that different countries are having with the United States are able to bring them down, these tariffs. And then what else is done to support the growth and not allow it to go into recession globally. So all of these are open questions which we will find answers to in the next half a year, 5-6 months, are going to be very critical. As of now, I mean, there is some decline in the projections, like RBI projection for India for 2025 and 26 was 6.5% growth rate, but IMF has come down and has brought it down to 6.2 for 2025 and 6.3 for 2026 for India. So there is already some kind of a downward pressure on the growth rates projected for India. But one has to see how the situation evolves.
Okay, okay. No, Mr. Kumar, you're very strongly pointing out to instances of Chinese dumping in other countries. So do you foresee a very good possibility that inflation in our country may be actually even less than the 4% that Reserve Bank has now forecast for this year?
I think inflation-wise, we are now seeing not so much of an issue. First of all, the crude prices have come down below $75 to a
Yes.
barrel. And all other commodities are also heading downwards because Chinese economy will be slowing down. And that is a major source of consumption of these commodities. So that is one factor. Then the projections of our monsoon, our predictions of our monsoon are going to be that it is going to be the normal one, and that helps in keeping prices in India in check. So I think from every sort of region or direction, you could feel very much convinced that inflation will remain range bound, so to say. And different surveys are also projecting the sort of inflationary expectations remaining anchored.
But, the normal way in which we are made to think about monetary policy is that it should be inflation plus 1.5%, the real rate. So most people were arguing for 4% CPI forecast, add 1.5%, which is seen as the real rate, and 5.5 would be the, the end rate of this rate cutting cycle. Do you think it can be even more, like, 5/4 of 5, considering that there are serious disinflationary pressures coming from the global environment?
This is something which one has to take a call, and the frequency of MPC meetings is, I think, very sensible. Every other month we meet, and so we will take a call when the more up-to-date numbers are available. And it's hard to say at this stage, but all of us in MPC were very much concerned about what is happening in the world economy and how it would impact India. And if necessary, we sort of take action accordingly. So right now, it would be very hard for anyone to say that it will go down to which level. But I think everyone is concerned and is watching and very cautiously. And there would be, I'm sure, no effort will be spared from either RBI or the government of India to sustain and protect or preserve growth rate.
Okay, but what is your own reading? I mean, your arguments are sounding very concerned about the global ambience in terms of a possible recession and possible Chinese dumping. So if you have to choose, do you think you are likely to see lower than forecast growth, as you say, 6.2 that the IMF has put out? What's your own reading? Do you think growth can be much lower than 6.5 and even inflation lower than 4?
At this stage, it is not wise to hazard because the actions can be taken to prevent that from happening.
Okay.
So it is possible that we are able to have a very good deal with the United States, which is very much possible. And it is also possible that other countries can also arrive at some kind of deal with the United States to prevent this global recession from happening in a very serious manner. So all of this is kind of something we need to watch, but not be concerned overly at this stage. So I think that's why I said next few months are going to be very sort of challenging in the sense that we need to be watchful and take action.
Oh, right.
So, yeah.
I get your point, sir. You don't want to jump into any conclusion at this juncture. But I have to jump into a commercial break. Coming back in a jiffy, and we have more questions for you. And I will be inviting my other guests, Suvodeep and Abhishek as well, back in a jiffy. Welcome back to a Monetary Policy Special. We have just got the minutes of the Reserve Bank's Monetary Policy Committee's meeting that ended on April 9th. And I have been speaking with the external member, Mr. Nagesh Kumar. Joining me now are two market experts. I have Abhishek Upadhyay, the senior economist at ICICI Securities PD, and Suvodeep, Rakshit, chief economist at Kotak Institutional Equities. Suvodeep, Abhishek, welcome to the show. And Mr. Nagesh Kumar, thank you very much for staying on. Abhishek, you all have read the minutes, and you had the advantage of listening to Mr. Nagesh Kumar himself. What are your key takeaways? Are you getting any sense of even more dovishness than you expected? Just what the key takeaways are.
Well, the broad message is very clear. The committee clearly has a very strong conviction about the inflation outlook. At the same time, clearly, compared to the last meeting, the downside risks to growth have increased, and that's why the committee downgraded the numbers also. With inflation expected to be a target and output gap, which is negative, likely to stay negative. Also, some of the worries on the external front, which were there, have persisted. But what has also happened is that dollar has actually weakened. There were worries that dollar may gain when if US were to impose high tariffs, but that has not happened. Also, crude prices have come down, other commodity prices have come down. So from overall, taking all these things together, it was quite clear that a rate cut was to be done. At the same time, more importantly, the committee is also guided for future easing by changing the stance to accommodative. There is some, it appears there is some difference in views, particularly in the external members, about whether immediate rate cut, is a done deal in the June meeting. One of the external members indicates that he's voting for the current stance only because rate hikes are on the table, not because immediate easing is imminent. Another member talks about upside risk to inflation, presumably from on account of currency weakness, etc.
Yes.
Our own view is there are downside risks to both inflation and growth based on information we have currently, and therefore we pencil in at least 50 basis points or more cuts from MPC.
Okay, thanks for that. Yes, I did notice Saugata Bhattacharya saying that, giving a sense that he's not game for a cut every time. At least that's the sense one got. Suvodeep, any key takeaways that wants you to change your mind in terms of how many rate cuts and when?
So, Latha, we were at 75 to 100 bips of rate cuts even going into the policy, right? So from that perspective, we were ahead in terms of what the consensus was expecting at around 50 bips. Look, it is in some sense derived from the fact that growth is on the weaker side. And especially after the tariffs have been imposed, of course, we have seen a lot of flux after that. There is a downside in terms of the growth, and we are looking at a range of around 5.8 to 6.2% kind of a growth with a point estimate of around 6%. With this kind of a growth and our inflation forecast being at around 4%, the growth inflation mix, the output gap opening up, helps in our call in terms of the, let's say, 75 to 100 bips. So when we read the minutes, I think it's important to note that even Dr. Ranjan is talking about the concerns on growth now being much more than the concerns on inflation. And to that extent, the accommodative stance, as well as, if you look at the global scenario, kind of indicates that the push should be towards further rate cuts. Of course, there will be divergence of opinion in terms of whether it's consecutive or whether you wait and do the rate cuts.
Suvodeep, 1 minute. My pointed question to both you and Abhishek is the dovishness more than what the market has factored in? For instance, Suvodeep, tomorrow should we see yields lower?
Good question, because see, I think it is for me, my read was that it is a little more dovish than what the market was expecting.
Okay, that was my reading as well. So, I mean,
Yes, and I think that should warrant some kind of a reaction.
Okay.
Whether now the OIS or the markets kind of look at a further 25 bips from the 50 bips of consensus, I think that we'll figure out. But I think
Fair enough.
it is.
No, I agree. You know, it will be more dovish because we are mentally also, we have become a little more worried about global growth. Abhishek, very quickly that question. Is it more than what the market has factored in? What may the minutes do to the markets tomorrow?
Difficult for a favorable surprise, Latha, with 10-year yield already close to 6.3 levels. End of March, we were closer to 6.6. Now we are closer to 6.3. Very difficult for, these minutes to, by itself lead to, further another, sharp leg down in yields. I don't see that happening.
Okay. Well, let me toss then, get the final word from Mr. Nagesh Kumar himself. So, there are a lot of people who share the grimness of the global environment that you have very nicely explained in your minutes. The US accounts for 4 trillion of exports, which is, almost the entire Indian GDP. That's the kind of exports they consume, and they were consuming it at 2.5% tariffs. Now you take all the average 20%, 25% on automobiles and steel and aluminium, and plus add the 10% on all goods, and plus add the extra tariffs on China. Clearly, the 2.5% has gone to 25%. Now, we are looking at a very serious situation. No matter what advantage we have over Vietnam or Bangladesh, that market is now going to come at a huge price. So do you think there will be a scope for a double cut at some point? What I mean is a 50 bips in one go.
Yeah. Well, Latha, as I said earlier, these are positioning, the tariffs which have been announced. They are kind of the starting point of a negotiation or discussion. So I do not think that at the end of the day they will hold. And so there will be in negotiations between different governments, different countries and all that. So the picture would become clear in, say, 6 months down the line. And then only you will be able to decide and, how much of a hit I'm taking in terms of my growth projections and what it means for our inflation, and then accordingly craft a response. Or it is very open at this stage whether there will be a further cut, whether they will, and how many of them, and whether double or single. So I think we have to keep watching and reacting as we go along.
Okay. And is your sense on inflation that we are going to be positively surprised because so many countries will not be able to push their goods to the US and will be looking for a home? See, the Asian output gap is really large. Whatever be the global output gap, there is no doubt that Asia was the production house of the world, and now that output will look for a home. So should we bet on much more serious disinflation?
Possibility, but again, it depends on what action government of India will take to prevent this dumping from coming to Indian shores, for instance. And if it is prevented, then it is not going to be that serious.
Okay.
But if it is allowed to come to our shores, then yes, it would be affecting the prices in the economy.
That's a very fair point, sir. There are people who are complaining already that the anti-dumping on non-ferrous metals is more expensive than the imported prices, and therefore it can actually be a bit inflationary. But thank you very much for giving us a many-sided insight into what is the thinking of the Monetary Policy Committee. And thank you, Abhishek and Suvodeep, for giving me an idea of how the market may interpret. As you all point out, already a lot of dovishness is baked into the yields. At 6.3%, how much more can the yields react? That's a good question. Thank you very much for joining me on this special monetary policy show.